Let's welcome in Nikhil Ranka of Nuvama Asset Management and Sanjay Parekh of Soham Asset Managers. Gentlemen, great to have both of you here. Thank you for joining us. Appreciate it. Let's do one thing. Let's talk about, we've been, of course, talking macro stuff and top-down stuff. So let's take the opposite route. And then towards the end, maybe I'll ask, Nikhil, I know you have, some thoughts on what oil itself, perhaps where oil itself settles, but let's reverse the order. So, Sanjay, let me start with you. What should, for viewers who are watching, I mean, historically, right, geopolitical induced oil shocks have been good times to buy. But of course, I mean, there are tail risks here we don't know how this will pan out. They're always there. So with that as a baseline, what would you do, and where are you finding serious dislocations? Because stocks were already down and they've been kicked down further.
And, you rightly said, so ours is, to start with, we are at 75-76% large cap. And after this reaction, pretty good opportunities in larger cap, across, a lot of choice. Another key point, we've seen crisis, Spain crisis, Greece crisis, Brexit, Ukraine war. And then, of course, last year when there was war again between Israel and Iran. And then we realized that all throughout, if we react when there is pain and sell out, it's absolutely, it doesn't help. You have to go through the pain, and the size of pain can be different. So this time, we all know that if it gets prolonged, you all have done a fantastic analysis of 5 million barrels a day into $40, 365 days is $70 billion. And we all know it's not going to last for a year. But even if it's 2 months or 3 months, it's painful. So all of us, we want to get this over maybe, or like a month or so. If that happens, then I think, markets will say, okay, March was bad, Q4 was bad, it's behind us, and back to basics. But it doesn't happen that way. So I think at least what we're doing is changing a bit, pivoting a bit, but not changing our strategy overall. And, like at least the largest market cap company, we added to that because we believe is far better placed. They will also have impact, but at least it's better placed. So there's a little bit of pivot, but no change in strategy that we have. Longer term, I think at least the government now should seriously have a policy which incentivizes E&P, which I've been tracking oil and gas for 30 years, and I've always been disappointed that we didn't have a policy which attracts investments in E&P, which I very, very strongly believe will happen, which is far more, attractive for potential investments in E&P.
Okay, so you're not changing the strategy too much, but shifting a little bit in what way, Sanjay? You said?
Yeah, so we added the largest conglomerate, the largest market cap company, because it's an integrated player.
Yeah.
It has an exposure to E&P.
Yeah.
If the cycle and this is assuming crude doesn't remain at 60, neither it remains at 120. If it comes down midway, then the cycle petrochemical spreads for integrated player can get better. Definitely the demand impact we need to see, but at least we believe, they would be better placed because they also have an upstream presence. And then telecom is almost, not affected by that. Retail certainly from a sentiment perspective will be affected, but the solar and the renewables, most of the players on a longer term as a strategy, certainly I think the government emphasis also will go up there, where they have very large investments. So we at least, we increased our weight in Reliance.
All right. Nikhil, at Nuvama Asset Management, are you all aggressively buying? If yes, what?
So, yeah, we are now, we do feel that the markets don't have much downside from here. So, Rima, if you typically look, whatever be major uncertainties, markets have typically bottomed in the first 7 to 10 days of those uncertainty. If you take the example of COVID, we bottomed out when we had the first 1 lakh cases of COVID. If you take Russia-Ukraine war, within the first 15 days, markets made a bottom. If you see even the Trump tariffs that happened last year, he announced the tariffs on 2nd of April, and we bottomed out around 9th or 10th of April in that sense. And this time around, if you see the starting point of valuations, we have been highlighting that 17 times 1 year forward is where markets typically bottom out. And even if you conservatively take 1400 rupees as the EPS for FY28, then today at 23,800, we are close to 17 times that number. And this time the earnings uncertainties, so to say, is not that clouded except for OMCs and to a lesser extent aviation. Rest of the sectors are not so much affected this time around. And my sense is this uncertainty should not last for more than a month in that sense, because it's not that any production facility has got disrupted. It's just that, logistics have got constrained. Once we have things moving from the Strait of Hormuz, then the recovery itself can be very swift in the markets.
Got that. Nikhil, so what have you at the margin done?
So we've not changed much. As I said last time, we were overweight on banking. We still continue with that overweight on banking. My sense is aviation is getting to a point where probably, larger names, one can look at it, because if margins stay at these levels, then obviously the other two players were loss making. That will put further pressure on them. So I think aviation is something that is starting to look incremental attractive, and at some point of time, I think 10-15% lower. Even OMCs will make a strong case in that sense, because this looks more a temporary disruption rather than structural long-term dislocation in that sense.
Never heard you talk about OMCs, Nikhil. That's a new one. 10-15% from here, lower from here.
At a price, everything is good, Prashant.
Yeah, no, absolutely. Absolutely. Sanjay, do you have, you mentioned one name, but I mean, anything else where you think there is too much dislocation which has happened, and maybe just by sheer numbers, it just is looking very attractive?
See, if we assume that it's not going to get prolonged,
yeah. Look, the markets are assuming this is going to last, this fight will last for about, the general consensus is 4 to 8 weeks is what we're 10 days in, right? So
then I think a lot of options you have now, the entire financials, ICICI Bank, because we know some of it is led by selling, which is forced selling, by some redemptions, by some sovereign funds, so these fundamentals, they're not going to have issues on asset quality. And now with, inflation certainly will look up. So interest rates have bottomed up, and you're getting the same stocks at almost at 5-7 year low price to book, ex-COVID. So all the larger banks we own, and we slowly going to add exposure there. Then of course, some of them which are not affected by them. Like telecom, I don't think telecom would have some element of, if diesel price spikes, then some of these towers needs diesel, where there will be some cost increase, but that's not significant. But otherwise, they're less affected. So there is one, we think at point the largest telecom player we have has value. So we are going to navigate and look into, because there's a lot of opportunities in Nifty now. But we will discretionary side will avoid for a while. So as I said, your impulse choice, you need to be selective, where also the downside, if things go a little extended, is less, and when the bounce back happens, you are better off. Metals is one more, where they certainly look resilient. So these are the few names where at least we will put our incremental money.
So Sanjay, other than consumer, have you identified any other sector which you will avoid in the event of a prolonged war, say the logistics costs go up or oil spikes? Which are the sectors to avoid now?
At least we will not, I see, like Maruti, Mahindra, they've become very attractive. But for now, at least, we don't want to play it. because the environment does get caution. Internally we're discussing in our team that today, if somebody wants to buy a car, obviously they'll defer or delay for a while. So you'll see that happening. And we are conservative as a society. So I think that's where we will wait. Let it get more attractive or let us see more evidence. And some part of the strategy is now we are not going to use all our money. We have limited cash that we will slowly deploy. And then when things get clear, you also can buy up. You don't have to, but we don't want to wait, as if the market is going to go down. We will slowly now nimble and use our cash gradually.
Nikhil, you want to name names? Anything? Spread the.
We can't take stock specific names.
Throw the net wide. 500.
We can't talk stock specific. We can only talk on sectors and market.
But have you run screens where, Nikhil, it's generally there is a fair bit of value emerging now? If in the broader market also, Sanjay, of course, is large. I mean, his portfolio also has a fair bit of mid caps, small caps, etc. But I guess, Sanjay, you're skewed towards large caps in that sense, right? Yeah. Nikhil, broader markets?
I think across the board, value has started emerging. Mid caps, anyways, had seen a very sharp correction even before this event happened. It's just that typically, in March, you have that pressure on mid caps because a lot of fundings book closed down. So that has got accentuated a bit. But my sense is overall, both on the mid cap as well as the large cap side, we are getting to a point where if things don't get too bad from here, incrementally, the pullback in the markets can be very sharp, because what you have to also understand is now the leverage in the system has not got completely wiped out in that sense. There's very little leverage that is sitting in the system. So if you have buying coming in from lower levels, the impact cost will be very high, and therefore the initial 1,000 points on Nifty can come very fast.
Nikhil, you said we're trading at 17 times FY28 PE, and that's the valuation multiple typically at which we bottom out?
Correct. So if you leave COVID and global financial crisis, which were events where it's very difficult to predict what the earnings would be, then typically 17 times is the trough valuation where we bottom out. And this time around, I would say, the uncertainty is not as high. Even if you take last year, Rima, we bottomed at 21,800 when the Trump tariffs were there and there was a lot of uncertainty. In 1 year, earnings have gone up by 8 to 10%. So the 23,800 of today represents what we were at 21,800 1 year back in terms of the valuation multiples. So therefore, in terms of valuations, we are today at the same level where we bottomed 12 months back.
No, interesting conversation, and I hope that 1,000 points comes quickly, sooner rather than later. But Nikhil, you had a couple of thoughts on oil itself, right? You want to quickly run us through that? I mean, just your analysis.
But I just wanted to explain why, with the today's G7 meeting of emergency oil release, that's put a cap on oil prices in the near term, in my view. So if you look at it, Prashant, we had crude product of 15 million barrels flowing through the Strait of Hormuz. 3 million was refined products in that sense, out of which China was 5.5 and India was 2.5. Now we've got permission to take Russian oil, and the estimate of Russian oil floating on sea is close to 152 million barrels. So even if we get 50 to 60% of that, we have 1 month more of supply covered in. My sense is beyond 15-20 days, China at least should get some relief on the Strait of Hormuz, so that 5 million barrel incrementally should start flowing at least for China, guys. And then you have to understand in the case of Saudi, there is an east-west pipeline with a capacity of 7 million barrels, out of which only 3 million barrels were getting used. So if they are able to shift the incremental 4 million barrels through the east-west pipeline and evacuate it through Red Sea, then we are essentially talking about almost 11-12 million barrels of dislocation which gets taken care of. And then if we have the SPR release from most of the sovereigns, then, that 2-3 million barrels also to a large extent will get covered. And therefore, my sense is it will be longer for higher, because then you will have also inventory replenishment. But for the time being, I think 90 to 110 barrels is a range that crude should start to stick in. The upside tail to that sense is getting taken care of because of this SPR releases.
I think daily consumption, Nikhil, daily oil consumption, world consumption is about 100 million barrels, right?
Yeah, 104.5. And before this crisis started, Prashant, we were at almost 108 million barrels of production. So there was a global glut in oil, because of which, if you see the consensus estimates everywhere, everyone was in that 60 to 65. Now, the only thing that is happening is the Russian floating stock will get used up, and what is there in the Strait of Hormuz becomes the new floating stock for the near term.
Okay, got that. Well, that's the math with regards to oil, but we'll talk more as we go through, what's going on in the Middle East, in Iran. Thank you very much for now, Sanjay. Appreciate your time here as always. Nikhil, thank you very much for being a part of this conversation. I think we'll take a quick commercial break here.